Thank you so much. It's great to be here, everyone. I want to thank you for the invitation. As I was sharing with folks before we started the actual session, I was a proud member of the Brooklyn Society for Ethical Culture for many years before moving to Philly about 5 years ago, and have almost no excuse except for, a global pandemic and teenagers for why I haven't graced the doors of the Philadelphia Society. So I'm hoping that this will do it, and that hopefully we'll all be in person again pretty soon. But I'm pleased to be here, and the work that I'm sharing today is some research that resulted in a book that I wrote a few years ago. And I want to start. I'm going to share my screen. I also want to invite you to interrupt me as I go. I'm totally fine with taking questions during the presentation or at the end, but I tend to speak a little bit quickly and in a way that people feel like they shouldn't bust in, but feel free to bust in if you want to. Okie doke. Here we go. I'm going to share my screen and put this on the slideshow piece. So I recognized, thinking about you guys and looking at your photos, those of you who have photos or your video is on, that some of us are probably contemporaries or maybe even a few years older than I am. And I wanted to start my story by just talking a little bit about what it was like to go to the bank when I was a kid. So I grew up in a small town, mostly of Polish immigrants in central New Jersey. And I would Saturday mornings often doing errands with my dad. We would go to the bank, we would go to the barber, he'd get his hair cut, go to Mike the butcher, the post office. And so this kind of ritual of going to the bank was just part of the week and part of the fabric of our lives. It looked a little bit like that bank on the left-hand side of the screen. And I remember, walking across that terrazzo tile floor and going up to the window while my dad would deposit his paycheck and maybe do some other business. And the woman, who's usually a woman who is a teller, would give me a lollipop. And eventually, when I was about 7 years old, I got my first bank account. And I remember being so proud to have that account. And this is where age comes in. Some of you probably actually remember having those passbooks where if you, put in your $5 or $10 of babysitting money or the checks my grandparents gave me for my birthday, you'd get that. They put it in that machine and you could see your balance going up. And sometimes you'd even see a little bit more than you had deposited, because back in those days, you actually got interest on savings accounts, which is something we're not really used to anymore. I remember at one point, after I had published something about the research I'm about to speak to you about, I got an email from a man who said he had brought his daughter to the bank to do something like my parents did with me and get that first bank account. And that they started it with $50, and then the next month came in to do that again. And he saw, when he looked at their statement for his daughter, that there were only $45 in the account because she had an insufficient balance, and he was outraged and closed the account. And that story, I think, indicates a lot of what I'm about to tell you about, which has to do with the way that the model of banking has changed and the way it increasingly doesn't serve people who are low income, who maybe live in neighborhoods where there isn't a lot of banking. So as we all know, banking has changed a lot. This is now a kind of an old picture of my kids, but it's kind of funny, right? For our children, my kids almost never went to the bank with me. If anything, we would go to these machines, right, where you could press a few buttons and the money would spit out. And it was an entirely different relationship to banking. And I would say now, when people are doing a lot more banking on their phones, people are even going to these machines less and less, because we're increasingly becoming a cashless society. So the beginning of the story of my research was a study that was done by the FDIC. And this is a study that's done every 2 years. For those of you who may not be familiar, FDIC is the Federal Deposit Insurance Corporation. And every 2 years, they do a study that they call the National Survey of Unbanked and Underbanked Households. And what they want to find out is how many people don't use a bank or have a bank account. And the numbers, even though this slide, this pie chart is from the data from 2013, it actually hasn't changed very much since they started doing the survey in 2009. And what it shows is that about 8% of American households have no bank account whatsoever. And another 20% are what's called underbanked, which means that they have a bank account, but they're also relying on what are called alternative financial services. And that is a big category that I'll talk about in a second, that includes payday lenders, check cashers, pawn shops, rent-to-own shops, et cetera. And these are often thought of as being kind of like the underbelly of the financial services industry, predatory lenders, et cetera. And so the message was kind of, well, if there's a problem here. I see somebody has something in the chat. I'm wondering, Mike, if you guys will monitor the chat and let me know if there's a question that I should address while I'm speaking. So the FDIC and other government agencies became concerned and really started thinking about why people, well, not so much why, but that people should be moved into bank accounts, that was the way to achieve financial health. And before I kind of move on, I want to just give you a sense of all of these different kinds of things that are thought of as being in this realm of alternative financial services that these unbanked and underbanked consumers use. So as I mentioned before, check cashing, rent to own, but also things like prepaid debit cards, which often cost a lot to use, title loans, installment loans. These are things that tend to be pretty expensive to use. And the idea really from a lot of policymakers was that there are good financial services, which are banks and credit unions, and then there's everything else. And that people should only be using the services that are in the good category, because partly the everything else is expensive. And I started really thinking about that. So that data was my kind of jumping off point. And I thought, well, this is almost assuming that people don't know any better. And the move was really to try to get people to open bank accounts, stepping over that question of why they were doing what they were doing. And most of my research life, I've spent working in low-income communities and communities of color. And I knew from experience that the low-income people I've worked with know where every dime goes. They have a much better sense of where every dollar goes than those of us who have a buffer, who may find $20 in the pocket of some pants that we wore last year and then didn't wear it until it got cold again. And so I was a little bit suspicious of this assumption that people were just too ignorant or didn't know enough about financial services to make better choices for themselves. And so I came up with what my primary research question was, which was basically, if alternative financial services are so bad for people, why are there so many people using them? Why do we have 20% of Americans who are using them partly, and perhaps the other 8% using them exclusively? And so once I started digging out a little bit deeper, I realized that the use of alternative financial services is large and growing. Right? So check cashing transactions grew from $45 billion in 1990 to $58 billion in 2010. This is not a category of financial services that's getting smaller. Payday lending transactions grew from 10 billion in 2000 to 30 billion in 2010. And actually, if we added up all the money that all the outlets of payday lenders, there are more storefront payday lenders than there are Starbucks and McDonald's combined. Now, those of us here, all of us are living in Pennsylvania, I'm assuming, although people could be zooming in from other places. Payday lending is outlawed in Pennsylvania and many other states in the East, but in the West and the Southwest in particular, it's a big and booming and growing business. Does everybody here know what payday lending is? I can stop and do a quick explanation if that would be useful.
Actually, Stan had a question, what underbanking is, the underbanked
Yeah.
population.
So the term underbanked is used to categorize or to label people who have a bank account, but they also use these alternative financial services. I actually, I mean, it's a good question because I don't really like these terms. I think that they imply that people are deficient somehow. If you call somebody unbanked or underbanked, I think of it as almost like uneducated or undereducated, which the implication is that you should be more banked, right? And as I found out doing my research, people have really good reasons for doing what they're doing, even if it costs them a lot. Okay, I'm going to assume you guys know what payday loans are, even though we don't have outlets here in the in Pennsylvania. And actually, looking at the data, we can see that people from all over, from any state, are using these services because you can get payday loans online. So I don't recommend you do this because you'll be spammed nonstop. But if you tried to get a payday loan online, you could certainly get one by the end of my talk. Don't do it. It's expensive, and I'm assuming people, which is probably not a correct assumption. I hope that people are more financially stable and don't need to use payday loans. But as I found out, there are an awful lot of people who one might assume were financially stable who actually need them. Okay, so fast forward.
We do have a question.
Yeah.
You have a question. What is payday lending?
Okay, thanks for the question. Here I am actually at a payday lending shop. Payday loans are small, very small loans, usually from about $50 to $500 that are labeled payday loans because you have to pay them back by your next payday. So you get this loan, the interest is quite high, it can be up to 300 or 400%. But you pay it back, and it costs about $15 per $100 borrowed. So you can see where the fee is. The payday lenders don't like talking about interest actually, because it's not really interest, it's more of a fee. And so when you get the loan, the only two things that you have to show are that you have a bank account. So these people are underbanked, not unbanked, and that you have a regular source of income, and they will verify your job or that you're getting a Social Security check or something like that. The problem becomes that people usually get these loans when there's an emergency, maybe their car breaks down or there's a medical event, and then when the 2 weeks come up when they're supposed to pay it back, they actually don't have the money, and so rather than just paying it again, they actually literally need to take the loan out again and pay another $15. So you can imagine that there's a cycle. People kind of, the term is rolling over the loan, and they often end up owing more than they took out in the first place. And so that's why they have this label of being predatory. So feel free to ask more questions if you have them. So I ended up, in order to understand this question that I asked about why people are using these products, working part-time for several months at a check cashing store in the South Bronx in New York City, and then at a payday lending store, which is where I am here in this photo, in California. And I was kind of able to get in because I had met this check cashing owner of a check cashing chain of stores in the South Bronx in Harlem, who really felt like he came to visit my class that I was teaching at the New School and really felt that his firm was providing necessary services for people and that they weren't just taking advantage of people. And his argument was pretty compelling. And I felt like if I really wanted to understand the question, I couldn't just look at data. I had to get as close to the problem as possible. And it was actually incredibly enlightening to do that work and to meet the people on the other side of the window and the people that I worked with, who really were able to explain to me some of the reasons people were doing what they were doing. And I would say the biggest takeaway I came with was that the consumer financial services industry is broken and customers are misunderstood. And so that we have banks who are increasingly focused on serving people who are already wealthy enough or have enough money to exceed those minimum balances, to use the services without usually paying anything for them, and then making money off of overdraft fees and other fees like that for people who are lower income and don't have a lot of money to act as a buffer. So if you think about that diagram I showed earlier with good and bad financial services, I came up with what I think of as a more accurate picture of consumer financial services, which is mainstream rather than just good, banks and credit unions, the alternative ones that I talked about. And then as I really got into this field work and started talking to a lot of people, a whole set of informal financial services, loan sharks, money guards, even people keeping their money in bail bonds because it was safe. And I'll talk very briefly about the other two here. Money guards, sometimes people with cash don't feel like the cash is safe in their home. Maybe they have a partner who gambles or who spends it on drugs or alcohol, and they'll keep it with somebody else, maybe somebody else who has a bank account. ROSCA is an acronym that stands for Rotating Savings and Credit Association. And these are small groups of informal groups of people who actually will create a situation of lending and borrowing amongst themselves. And I got to know a couple of these groups really well in the South Bronx. They're often based in immigrant groups. So this one was run by a Mexican woman. She had 2 or 3 of these groups going, and she would collect $100 a week from the 10 members in the group and then dole that out in $1,000. So the whole pot would go in week 1 to one person, for whom it would act like a small loan. And then week 2, go to somebody else, because everybody would pay in every week. And the last person, for them, it would be like forced savings. And what was really interesting about Marta was that when she collected that money, she would put it in her bank account. So she was actually using the mainstream financial services sector to enable this informal saving and lending. And so I'm happy to talk about that more too. It's really fascinating. I also found through the work that I did at these 2 businesses and then interviewing hundreds of people who use these services that, here we go. There were 3 things that people really valued. And the first one is probably the most surprising one, that a lot of people told me that using these alternative financial services like check cashers cost them less than a bank account. And so that may come as a surprise to those of you who have banking services for free or who pay very little to use a bank. But once you get into the really talking to people about what it means and how they're paying for what they need to do, it made a lot of sense. So for example, let's say that you're getting your paycheck on a Friday, and you actually get a check, which a lot of people do. We use more checks, paper checks in the United States than any other country, even though we're moving more and more to direct deposit. You get that check on a Friday and you have bills due, you have no food in your house, maybe you have to do some other things. If you deposited that paper check into your bank account, it might not clear until Tuesday or Wednesday, right? We all know that's something called float, where or friction in the industry, where there's this period of time where you can't access your money. Meanwhile, your kids are hungry. Maybe you have bills that are due that day or on Monday or Tuesday. And if you start to write checks to those people that you owe money to, you could run the risk of that check being cashed before your money hits your account. So suddenly you've paid, you're paying $25 or $30 overdraft fees, and your kids are hungry because you couldn't buy food yet, right? You don't have a credit card, maybe your credit score is really low. So to put maybe a little bit of a greater description on it, let's say you have it's $100 check. We charged at the business I worked at 2% of the face value of that check to cash it. So there's $2. It costs $1.50 to cash to pay each of the bills you want to pay, maybe your phone bill, your electric bill. So let's say you pay 4 bills times $1.50. I'm going to keep the math really simple for myself. That's $6. So now you've paid $8 out of your $100 check. And if you just look at that on the surface, that seems like a lot of money, 8% of the check, the money that you worked really hard for. But if you get one overdraft fee from that, that's going to be $25 or $30. And I bet almost everybody who's listening has had one overdraft fee at some point, and maybe you argued with your bank and you got it removed, or maybe you just paid it because it wasn't that big of a deal for you to eat the $25 or $30. But for people who are living very close to the edge, it's a lot of money. Bank fees are increasing. So one of the other things I found doing this research was that I had to go back to and talk to a lot of bankers and bank policymakers. And you don't actually have to look at the details in these graphs. The most important thing is to look at how the lines are sloping up to the right. So ATM fees have gone up, monthly checking account fees have gone up, minimum balance fees have gone up. And so all of those things make banking more expensive for people. And there are a couple of reasons for this. One is changes in banking policy. So we know that banking policy got really strict after the Great Depression, and then it got more and more lax, especially during the 80s when banks were allowed to do more investment banking too. And they changed their practices from relying more on interest income to relying more on fee income. 90% of the overdraft fees that banks make come from their 10% of poorest customers, right? So they are mostly making that money off of low income people. I looked at some of the consulting firms that help banks really maximize what they make. And a couple of them said things like fee income is the gold mine of checking. A banker that I interviewed said it's like a drug. Once you get this, it's like a drug. And even though this is becoming less common, at the time that I did my research, there was even a very common practice called check sequencing, which I'll try to explain simply. Let's say you have, again, I'll say it, let's say you have $100 in your checking account, and you have charges against that account in the amount of $25, $50, and $70. All those checks, you've written them to maybe your babysitter and a house cleaner and your phone company, and all those checks hit your account on the same day. The bank could put them in the order of smallest to largest. 25, then you'd have $75 left. 50, then you'd have $20 left. And then the 75, which would trigger an overdraft fee. What they do is resequence them from largest to smallest, putting the $75 check in first, then the 50, which would trigger a first overdraft fee, and then the 25. So they're getting 2 overdraft fees, maximizing the money they're getting from you, which to me does not seem like customer service, right? They're not serving you, they're trying to make money from you. If we compare payday loans to overdraft fees, the average APR of an overdraft of a payday loan, that's annual percentage rate, is about 400%. And that's the thing that makes people crazy and say these are predatory loans. But if you think about an overdraft, it's actually like a small loan, right? You are borrowing money from the bank, and they're charging you that $25 or $30. And if you calculated the APR of that, it would come out to about 5,000%. So what I started to think was that it seems wrong or perhaps inaccurate to think of banks as good and these other guys as bad, and that people are actually making more rational decisions about the way that they're managing their financial situations than we give them credit for. The second thing people talked to me about was greater transparency, that they felt that banks were always tricking them, that the terms changed, and that they weren't always aware. They were surprised by these fees. And so one of the things that you get when you sign up for a bank account is a disclosure agreement. And I think we're all used to seeing these things online now, where you have to kind of like scroll down 40 pages and click, yes, I accept the terms, without reading them. If you read them, it would probably be the only thing you could do. But more and more, there are these things that are hidden in the disclosure agreements, and people end up not trusting them. And I would say particular people of color and people in low-income neighborhoods, where banks have been taking advantage of them and giving them inferior terms for decades, if not more than 100 years. Actually, in the Philadelphia Negro, W.E.B. Du Bois writes about this. These disclosure agreements and transparency are a second issue that people talked about. And I want to just show you two photos that I think makes this really clear. This is just generic bank lobby, right? So imagine that you didn't go to the bank with your parents like I did when I was a kid, or maybe you're just a new immigrant to this country and you walk into a bank. I think I would be pretty confused, right? There is absolutely no signage here, except there's something back there about loans to tell you what's on offer, right? And so as the financial services industry has become more complex, it's very hard to know what you're supposed to do in this place. It's not clear what the products are, how much they cost. You have to ask one of those people, and you may be intimidated thinking about not knowing even what the right questions are. So I contrast that with a photo of the check cashing store that I worked in the South Bronx, which almost reminds me of a fast food restaurant, you know, with those big signs above the counter that, you know, to show you what combos you can get. And so these signs show you that it costs 2% of the face value of your check to cash it, $1.50 to pay a bill, 89 cents to get a money order, which is less than the post office charges. And that you can also get these other things here. If you looked closely, you'd see that you could get stamps. You can buy a Metro card, which is the subway card in New York City. And so that really communicated to people that this was a place where they knew what they were paying. There was no trick. And they could also do these other things that were important to them. It was convenient. Also, it's open 24/7, which is another thing in terms of banks, which don't always work with working people's schedules. The third thing that people talked to me about was better service. And I think we've probably all seen those, you know, if you ever read an article about payday lending or check cashing, there's usually just like very kind of shadowy place with a blinking neon sign and people who look kind of suspicious. And I usually say, like, go into a bail bond store or a check cashing store. Most people that talk about them have never been in one. But people talked about the way that they felt well served in these businesses. This is actually a photo from a training that I had to go through at the Payday lender. And the point of the photo was we were supposed to, as trainees, find out what was wrong with the picture, what this teller on the other side of the window was doing wrong. And the answer is simply that she has her phone out, which is a sign that she may not be focused on the customer. So, you know, one of the things that I was really impressed with immediately from from working in these two places was how well the tellers knew the customers. In the check cashing store, both of the women that I worked with on a regular basis had been there for more than 10 years. Most of the people in that business were Spanish speaking, and I spoke Spanish, but it was really interesting how when I started working there, nobody came to my window because they didn't recognize me. They probably, given the way I looked, didn't think I would speak Spanish. And people did all kinds of, people came in with all kinds of other requests other than their money sort of requests. Sometimes people would come in with maybe their jury duty letter from the city, which was written in English, and they would ask us to translate it so that because they didn't know what they were supposed to do. We got, people were loyal. I would argue that maybe having that face-to-face interaction made them pay their loans back more quickly. We were offered tips. There were a couple of times when the women I worked with, I had to kind of ask them about why people were doing what they were doing because it was unclear to me. And so the first time I got a tip, I was working with this guy named Carlos who brought in a pretty big check. It was about $5,000. He had his own business as a small contractor. And so Carlos brings the check. I recognized him as I was calculating the fee for cashing that check, the 2%. I realized it was a real chunk of money, right? So here I was studying this, but I give him his money. He slides a $10 bill under the window, which was my tip, which the first time it happened, I kept sliding it back until the woman I was working next to said, no, it's your tip. And I would wager that none of you has ever tipped your bank teller. I'll collect on that bet if you want to take it after the talk. But after Carlos left, I turned to the woman who had trained me and I said, Carlos could have done something, with that money. He could have put it in his kid's college account. He could have taken his wife out for a couple of nice dinners. Why is he paying this money? He's probably got a bank account. And the woman who trained me said, well, first off, it's Thursday, meaning tomorrow's Friday, and he probably has to pay his workers. And it's likely that his workers are undocumented or that they don't have bank accounts. And so he needs to go around to his job sites and pay them in cash. And indeed, having worked on my house in New York City, I knew that to be the case. I had seen our contractor come and pay his guys in cash. Or she said, maybe he got a job that he needs to start tomorrow, and he can't get that job and start tomorrow unless he has cash to buy the materials he needs. So if he were to put that check in the bank, again, this issue of liquidity, he would have to wait and he would lose that job. And so once I started hearing stories like that, it started to really make sense to me. Some of our customers knew how we took our coffee and brought us coffee in the morning. The woman, one of the women I worked with was very pregnant when I joined, and when she gave birth, people dropped off baby gifts. And so I really began to see this as a place that was more about service and community even than simply for transactions. And one of the women I interviewed said, it's like family. We know all of them, meaning the tellers. So kind of circling over to a conclusion, I feel like it's really important that we reframe this debate from thinking about people who are unbanked to people who lack financial health or who are victims of financial injustice, and thinking about how can we rethink the whole financial services industry to one that focuses on financial health and financial justice. I tell these, when I talk to banks and credit unions, I ask them to really rethink about their customer situations and focus on their needs, and to think about unlikely partnerships. There was actually a credit union in the neighborhood I worked in the South Bronx that partnered with a check cashing store, because check cashers aren't allowed to take deposits and have accounts. And so this check casher worked with the credit union so that when people came to cash their checks, they could actually do a deposit into their credit union account. And that made some sense to me. And also to make the case for credit unions and for banks through more powerful marketing about the services that they can provide to lower income customers. So I have lots more stories to tell, but I'm going to stop there and just open up for questions.